Investment, and Mr. Daniel Phua, Siloam's Group CFO. The webinar will be divided into 3 sections. First section is the delivery of financial and operational results by Mr. Daniel Phua. Second section is the delivery of Siloam's business update and strategy by Mr. Farun Khanna. And lastly, we will open up the floor for Q&A. For participants who want to ask questions, please use the Q&A function in your Zoom screen and feel free to ask questions during the sections. If you wish to speak directly to the management, please use the raise your hand function and I will enable you to speak. Without further ado, I will pass on the floor to Pa Daniel.
Thank you, Willie. Willie, if you can bring on the first slide, please. All right, welcome everyone. I'm very excited to be able to share Siloam's 1Q results with you, primarily because it's basically our best ever first Q that we have recorded. I think what is exciting about this quarter's result is that you have seen basically 3 quarters of sustained growth in both our revenue and our EBITDA. Yeah. If we basically look at the revenue for this quarter, we end at 2 trillion and the EBITDA is at 600 billion. I mean, both is basically slightly up compared to 4Q of 23. Now, if we were to compare these results to 1Q of 22, this represents basically a 17.2% increase in revenue and a 47.5% increase in EBITDA. Net profit is booked at 257 billion, represents a over 150% increase compared to the year before. Now, what's interesting about I think this first quarter is that typically I can see it has been sustained quarter on quarter. I think we're very excited to see that the 1Q23 compared to 4Q22, it is a small improvement as well. Performance is sustained. There is no swing in between quarter. It's very important from management perspective because we always promise the investors that what we're looking for is not swing, but to have a strategy to be able to deliver sustained growth quarter on quarter. And I think if you look at the results, I mean, that has been demonstrated. And the other thing is that if you were to look at EBITDA margins, I think this is also important to highlight. We've had 3 quarters of sustained post that 29% EBITDA margin that's been maintained for 3 quarters continuously. I did previously guide the market towards that, the fact that we want to achieve at least a 25% EBITDA margin. We've managed to outperform that 3 quarters in a row. Now, if you would ask me, look, how would things look like going forward? Q2 obviously typically will be a softer quarter due to Lebaran, and EBITDA margin will be affected similarly. But at this stage, there's no reason to expect Q3 and Q4's EBITDA margins to be significantly different to what we have achieved even over the last 3 quarters. Certainly, management has a strong focus on the cost management. Yeah, I think in Q1 the various EBITDA savings initiative has yielded us, about 20 to 30 B in savings. Carry us forward into future quarters as well. Next, please, Will. The other thing that I've highlighted before that the management has been working very hard on, and this is reflected in the improvement operation cash flow as well, is to work on improving working capital days. Inventory days is now at 31 days. Receivable days down to 47. Payable days again remain largely unchanged. It is something that management work on. I do believe that there is room to improve that despite the achievement that has been demonstrated in here. We certainly are working initiatives to look at improving receivables. We've looked at various ways of implementing management. Next management continue to improve as a result, and therefore result in less cash being tied up, and then obviously invest both hospitals and equipment. The other thing you will notice, obviously, from the operational cash flow is that there is been a steady step up in the cash that we've been spending. This allows us to invest more in the equipment. As you no doubt noted, we have a lead in terms of our average revenue per occupied bed due to being able to offer high acuity services, and we certainly intend to maintain that lead. And the strong operational cash flow that's been generated allow us to continue to invest in improving our services and also in the opening new hospitals. We certainly see that the utilizations, for example, of our equipments have improved as well. It is something that we are monitoring very closely internally as well. So that is the financial updates. Oh, sorry, the last one. In regard to the dividends. So we are proposing a payout ratios that is similar to 2021. So a payout ratio of 36% to NPAT. So based on the NPAT that was in the last month of 710B, the dividend that will be declared based on this payout ratio will be 255B. So a slight increase compared to what was paid last year. This is 9. May 25th. And with that, that's all the financial update from me. I'll pass the time to Mr. Varun Khanna to present the operational and business update.
Thank you, Pak Daniel. Pak Varun, the floor is yours.
But nonetheless, welcome. We embarked on a 5-year strategy in 2019, and we've alluded to that in the past as well, which is a 4-pillar strategy: core growth, clinical programs, network expansion, digital health. We've been immensely focused on execution and sustainability. We've transformed our businesses across the core areas, and now we are looking at enhancing the adjacent spaces. And during the course of the year and beyond, we'll touch upon that as well. In 2019, if you all recall, we had 17 new hospitals in our portfolio, and majority of these hospitals, some of the 7 or hospitals, and during the coming quarter. Another piece that we're adding this time is talking about our craft group performance as well. We record 6 craft groups, which are our leading craft groups. So, mom and child, neurosciences, and what's interesting is we're seeing significant volume growth across all our craft groups. So this is an interesting part of our performance for the first quarter. First quarter generally does see the impact of seasonality. What is seasonality in our business? Some kind of fever would strike in generally in the first quarter. and that would lead to occupancies going up. This is one of those quarters where we had no seasonality-driven revenues, and all of the revenues that we have seen enhancing are driven by core base case performance getting better. So you see a 40% in mom and child, 30-odd% in neurosciences, 28%, 33%, 25% respectively, and 22% in oncology. So it's been a very robust build-up on the front of our clinical programs, and that is what makes this performance sustainable. I think my co-worker Daniel said that now we've seen 3 consistent quarters of 29.5% EBITDA, and we do expect this year to sustain very much on these lines. Apart from this, we did mention to you in our last quarterly meeting that we started the transplant center. We got our approvals, and we're building from strength to strength when it comes to the kidney transplant program. We've already done about 260 procedures with a 1-year success rate ahead of a global benchmark, and that is what gives us joy and pride. We're able to deliver quality outcomes which are to the global benchmark levels. IVF, similar story. Not only are the cycles getting better, but we have a pregnancy rate which is again better than the benchmark globally. Another that I think we've led the industry in Indonesia is and has been giving us the leading position as well. We are providing a more seamless and comfortable patient experience, which is supported by digital capabilities, things like express checkouts, digitization of medical records, digital laboratory and radiology services. You'll see us rolling out our digital lab and radiology this quarter, telechat and teleconsultation with the specialist, and as well as a wide range of digital patient channels. Our digital channels actually include live chats, WhatsApp, my Siloam app, and we recorded 172,000 outpatient bookings this quarter through these digital patient channels, so which is an 18% contribution to our total outpatient for this quarter, which is higher than our previous quarters. Our My Siloam app, which continues to gain popularity, been downloaded 1.5 million times during the last year. Our web platform, our website, that's a very interesting story. We used to get about 100,000 hits per month onto our website in 2019. We've done a lot of work. We've enhanced a lot of content, and a lot of developments on the web platform. We again feel happy that 3.5 million hits is what we get every month onto the website. And it's not just hits. We've been focused on converting it as well, and there's a significant amount of conversion that we are seeing from the web traffic into our hospitals. So I think, Willie, I'll hold on till here and happy to take questions if any subsequently.
Okay, thank you, Pak Daniel, Pak Farun. So I will now open up the floor for Q&A. So hi, Ari.
Hi, good morning, everyone. Thank you, Willie, for taking the question, and also appreciate the updates from Daniel and Varun. Well done for the strong first quarter result. So my first question in regards to the kind of key drivers of growth, sustainable growth in the next few quarters. Earlier you alluded to the second half having more productive days. Any possible drivers that could basically drive that revenue stronger in the coming quarters? That's my first question. Thanks.
Thank you, Ari. So allow me to take this question, and then maybe Daniel can add. So Ari, clearly productive days is one part of it, right? Complexity is another part of it. We've been very focused on developing subspecialties. So if you look at our oncology business, we are adding subspecialties on the surgical side, which will then allow for better conversion happening in our hospitals. We did allude to the fact previously that while the OPD numbers are growing, we are more focused on now converting the OPDs to IPDs so that we don't lose patients to any other part of the world. We've seen significant trend of people preferring to stay back in Indonesia if you're able to provide them adequate curative surgical measures within the country. We've seen our conversion levels at 3.3 odd to the OPD numbers that we do. And we are reasonably confident that with the interventions on talent that we are bringing in, and Daniel alluded to, we adding more on technology by virtue of focused CapEx deployment in the medical CapEx deployment, which is on technology largely. We do expect our conversion rates to go up from 3.3 odd closer to 4 over subsequent quarters. So that will become a significant IP driver. And the third element that I think I've alluded to, but I'll reiterate, we do see our our hospitals, which is lower in the order, where we were struggling in the past. They will start to bring in significant EBITDA contributions going forward, and that's a sizable chunk. When we talk about 17, 18 hospitals getting mature and crossing the maturity curve, and then being productive, so that adds to the network quite significantly. We've had very robust and significant performances coming in from our top tier hospitals. Now this will be aided by the lower tier hospitals, the BPJs or value seeker hospitals as well. So that's another significant piece that we see. We do imagine that some of the software services that we're looking at will also add, the digital capability will also add. And the last part that I can leave you with is medical checkup services. First quarter is always the weakest because fourth is always the highest. And as we go into the next 3 quarters, we will start to see a significant ramp up in the medical checkup services, thereby adding to them as well. So, Daniel.
Just add a bit to what Varun's mentioned before. I mean, other key drivers that will affect Q3 and Q4, obviously what we've alluded before, the price increase that's taken into effect, and obviously the BPJS tariff adjustments as well would obviously continue to benefit going into Q3 and Q4. And just to add upon what Varun mentioned, the way we build our budget and is that each of the hospitals need to identify the clinical, the center of excellence, and also, I guess, the new clinical programs that we'll be launching, right? So we obviously brought you, I mean, Varun has talked about IVF, the kidney transplants, things that are more exciting in a sense, but there's also a lot of other programs that the various hospitals will be launching this year that will be new, right? Some will be launching cardiology services, some will be launching a maternity related services. So some of those drivers that you see will basically be hospitals, I mean, launching services that they, or clinical programs they do not have before. And as Varun mentioned, as the ramping up hospitals come out and gain maturities, usually what will happen is that they will start to move away from the 4 general specialty areas like pediatric, internal medicines, and into more specialized areas. So these new services will basically drive the growth going forward as well for this year. Thank you, Ari.
Got it. Thanks for the color there, Daniel and Varun. And then in terms of the kind of market shares, right? So can you share further color on how basically the Siloam is possibly gaining market share, or just or a both function of the market recovering to pre-pandemic levels as well? Thanks.
Thank you, Ari. Again, allow me to lead the answer, and then maybe Daniel can add. Yes, we, at least in the space that is listed, we do see that we are gaining share, and that is led by multiple facts. One, I think we're perceived to be doing more complex work, which is quite evident in the RPOB numbers. Our RPOB numbers are significantly better than our competitors, and that helps us get more complex work into our system. So that's one. Two, our corporate and insurance partnerships are at all-time high. I don't know if our pack will contain these numbers, but over the last year, we've added 890 new accounts. Our cumulative accounts have grown to 1,500. 5,100. This number used to be less than 1,000 for 4 years back. So that again provides us, a significant ability to provide comprehensive services to corporations and insurers, and that continues to give us sustainable business. And that's also where we've led some share on account of this. 3, our digital capabilities are significantly more enhanced than any of our competitors in Indonesia, and they are to the global standard. We are the only network today that can provide you your reports digitally. So it's an end-to-end digital service, and Indonesians love it. So we've seen significant growth coming in from there. We used to cater to about 3 million patients a year, and the 3 million growing to 4 million is what we're looking at for this year. And that's not the growth of the market. The growth of the market is lower. So in the premium segment for this country, so we actually look at our market share in 3 different segments. One is the premium segment, the other is the value seeker segment, and the third is the BPJS segment. Our premium share, to our assessment, is already at 15 to 17%, and that is the one which is growing high teens. From a growth rate standpoint, the market growth is only 5%. So I think that trend will continue, and that's driven by Siloam 5.0. We've done a lot under Siloam 5.0, and I think that's now yielding results and will continue to yield results in the foreseeable future. Dan, you may want to add.
The other thing, Ari, just to go back to your questions as well. We don't really look at a share of market per se. We do believe that Indonesia is a very underpenetrated market as is, and really what we're focusing on is being able to reach more populations through our growth in the services. But we've always shared in the past as well that we are constrained by supplies. And I think the advantage for Siloam is that we basically employ about 9% of specialists. They are currently kind of practicing in Indonesia. So it is definitely an area that we will continue to focus on, and making sure that by having the best equipments and best referral network, that we continue to attract the best talent. I think there's more in terms of how we look at the market than to look at the kind of a share wallet or market share per se.
Understood. Thanks, Daniel and Varun, for the color. So my last question is in regards to the EBITDA margin. It's already well exceeding the above 25% target, close to 29 to 30%. How should we see the possible room for further improvement from here, assuming that basically operating leverage continues and cost controls efficiencies are being implemented? Is it reasonable to expect that they could well exceed 30% in the coming quarters? Thanks.
Let me take that question then. Let me answer it 2 ways, Ari. The first is I see no reason why EBITDA margin cannot improve further. But certainly internally, once we analyzed it, both for OPEX and material costs, there are rooms to optimize it further. But then again, for me, I always don't want to be too aggressive. I'd rather give you a target that we outperform than to give you a target that we don't hit to. So I guess, certainly yes. I would say the answer is that the EBITDA margins can be higher than what it is today. The gains are obviously might come a little bit slower because we have hit more of the obvious areas. But then again, bear in mind that in that some of the gain will also come from the ramping up hospitals, I guess, getting more profitable and therefore improving the margin as well. So the simple answer, Ari, is yes, but I would not want to give out any specific numbers at this stage. It's certainly something that management will continue to work on improving.
Okay, appreciate the color there, Daniel, and all the best for the Siloam team.
Thank you, Ari.
Thank you, Ari.
Thanks, Ari. We have another one raising hand, Vanessa from RHB. I will enable her to speak.
Okay. I will. Can you hear my voice clear?
Yes, we can hear you.
Yes, Vanessa.
Okay. Hi. Thank you really for taking my question. Hi, Varun. Hi, Daniel. Well done for the strong results. So maybe a couple of questions for me. After the strong results in the first quarter, Any plans to revise up your guidance maybe?
At this stage now, I think the first Q results were certainly within our expectations and in line with the guidance I've given to the market. So at this stage, no, there will be no change to the guidance that we previously given.
Okay.
Daniel, Vanessa, Daniel, if I may, please. I've known Daniel many years now. Vanessa, he's already upped very subtly his thought around 25% EBITDA going to 29% EBITDA. I hope you've registered that because I think what he said while he was announcing his financial results is that this has been a strong quarter. It's been a very strong quarter and a very strong quarter based on base case performance. So I think the way we see it is the third and fourth quarter will be in line with this EBITDA percentage, and that is significantly better than what we gave as a guidance earlier. So I think that certainly should be noted.
Okay, got it. And regarding your capex, any color regarding your capex guidance and the allocation for this year?
Dan, are you taking that?
Sorry, Vanessa, I didn't catch that.
Daniel, the capex.
Capex remain unchanged. I think it's the same. Basically 700B, around 700 to 800 for hospital expansion, another 7 to 800B for kind of existing hospitals with the new equipment, maintenance, and so forth. Yeah, so that remains unchanged.
Okay, so about 1.5 trillion, I can say.
Yes,
Okay.
you can. So it's the same numbers that I gave previously.
Okay.
I think it's good that you get a contrasting view from both the CFO and the commercial. I do not disagree with what Varun says, just to be clear. But usually I will give our numbers that will be slightly more conservative. But obviously, as analysts, you guys will need to make up your own mind. But the fact is, we did have 3 quarters of sustained 29% performances. One quarters you can, like last quarter, I did say that there was some tailwind coming in from the reversing of some of the provisions for COVID treatment. This quarter, there's none of that. Yeah, just in case some of you were wondering. Well, this quarter, basically, there was no reversals of provisions either. So this quarter's performances was purely based on the operational performances and managements.
Okay, so we can say that this quarter should be the base year for your growth going
ahead. I should hope so.
Okay.
Vanessa, again, I think our business is not a guidance business. So in all honesty, we always say that we are there when people need us, not that we want them to need us. But I think the way we've seen historical performances in the Indonesian health space is that third and fourth quarter, there are reasons for significantly higher top line over the first and second quarter, and I'll tell you why as well. Fourth quarter historically for every hospital, this is not us, right? For every hospital in Indonesia is the highest medical checkup quarter because as you know, corporates have particular funds and particular budgets, and those budgets go to a reset every first quarter. And fourth quarter, there's trust me, we find it difficult to accommodate people when they turn up for medical checkup, and that's the level of volume that happens. So that is expected again. Third quarter is a very productive quarter because you don't have any leaves impacting, and therefore the number of productive days really goes up. So we see our performances, more like that, not from a seasonality standpoint, to be honest. So if you have the third and the fourth quarter, will have about 10 and 7% higher productive days. So if we are, X amount of revenue per day for each productive day, just multiplying that by the enhanced number is going to give us better revenues. So that's the way we see it. Also, first quarter does not have a full quarter impact of price increase. Daniel alluded to that. The subsequent 3 quarters will actually have a full quarter impact of a price increase as well. And last part on the EBITDA side, and I think we did talk about it in the financial year, full year results. We, as a management company, have limited bandwidth. So what we do is every year we pick up 2 to 3 areas that we want to impact on the midline, right? We did impact a lot of things in the midline last year. We were able to optimize a lot of our service revenues and drain significantly higher profitability or margin to our bottom line. This year again, we are working on 2 to 3 line items, and this time we are impacting a far sizable chunk of revenue, which is diagnostics. We are currently evaluating various options where we can actually drop the net cost on our diagnostic business. And as we proceed through the year, we'll start to see more success in that, and that will also add to better going forward. So I hope that answers your question.
Okay, got it. Thank you.
Maybe just let me add a little bit. I mean, since we are on a tone of looking at the positive side, please again don't take this as guidance from me specifically, but it's just a few, I guess, notes for you to do your own math. Keep in mind that Q1 would have reflected most of the salary increases, the increase in pricing from the vendors for the drugs as well. So that would have been reflected mainly in Q1. As Varun mentioned, Q3 and Q4, we do expect that from a revenue perspective to be a stronger quarter. Also that the price increase and the BBGS tariff adjustment would have had a full quarter to run in Q3 and Q4 as opposed to Q1. Now, as revenue improves, the fixed cost absorptions obviously improves as well. Yeah. So again, don't take this as a guidance, but if you were to do the math, that should allow EBITDA margin to also improve.
Okay, got it. And looking in the second quarter, I know that second quarter hasn't done yet, but I know that also given the Lebaran festive, there might be a drop in terms of the traffic and so on. But during this year, can you share some color regarding the drop in terms of the traffic? Is it better? I mean, is it the drop is softer if you compare to the previous years, or how is it the tone for the second quarter?
So, Vanessa, too premature. We're just in the first month of this quarter. I think we'll refrain from answering this question. But whatever seasonality impacts that we've seen are quite consistent through every year. It doesn't change. The volatility is not too much, right? If last year was X and X, particular reason to say it'll be X and Y this year, it'll be X and X this year. But it's too premature for us to make any comment on that. I don't know if Daniel has a view. Thanks, Dan.
Okay, got it. And talking a bit regarding your buyback initiative over the last previous years, if I'm not mistaken, you buy about 2 or 3 hospitals last year. So maybe during this year and maybe going onward, do you plan to buy back another 11 hospitals that you still rent? And if you and regarding the previous buyback initiative, can you share regarding the valuation multiple?
Let me answer that. Well, we only bought that 1 hospital here, Vanessa, just to be clear. I mean, that is the Surabaya hospitals. And that was a purchase based on multiples. I think all the information has been disclosed previously when we reported it. It was based on the valuations that has been independently appraised. Now, as to whether we will buy back more hospital from First REIT, possible, yeah. So we obviously we are generating kind of 1.5 trillion plus of operating cash flow a year, and we have basically no debt. So there's definitely a lot of operational leverage that we can explore. Now, we look at each decisions individually as to what will provide the best shareholder return. It could be buyback of hospitals, it could be purchase of a brownfield hospitals, it could be opening a new hospitals that allows us to tap, or it could be investing more into digital and the adjacent businesses. So I wouldn't say that is absolute one or another, except to say that we have a very tight internal processes now in evaluating the deployment of capital as to what would be optimal. Yeah, I guess if you were to look it out over the medium to long term, all of them will happen. We will buy back hospitals. We will open new hospitals. We will do brownfield acquisitions. The timing of it obviously would differ depending on kind of what offer we're getting, what prices we are getting, and so forth. For example, the buyback of the Surabaya hospitals, I think I've previously mentioned to investors before, is that that has a few advantages for us in that one, it actually improves the NPAT as a whole on a year-on-year basis. And as a result of reduced depreciations, but when we buy back the hospitals, depreciation decreases over time, as opposed to, in the right of use situations whereby depreciation increases over time. But then again, whether we buy back the hospitals or not, it also has to depend on the price being offered. Has to be at the right price as well, whereby we do believe that the net present value exceed the cost of funds. But then again, that is also obviously evaluated against other opportunities, such as other brownfield acquisitions and opening of new hospitals.
Okay, got it, Daniel. And maybe can you give also more color regarding the franchise model? How many hospitals currently under franchise model, and any color regarding the upcoming expansion also under the franchise model? How is the interest coming from the other parties as well?
Well, first of all, Vanessa, I wouldn't call it a franchise model. But we don't sell our brands, such as, let's say, a McDonald's would do. Is what we call a managed services model. So far, I would say that in terms of managed services model, again, coming back, this is where we actually manage the services end to end. Yeah, it's not just that, we sell this franchise, the Siloam brand for some other operators to use. So far, we only have the Cempaka Putih, HVJ hospitals operating under the current model. Now, are we looking into expanding the model? I would say yes. I mean, we are having different discussions, including potentially doing joint ventures as well. But obviously, when there's something that we are ready to announce, we will certainly let you know.
Okay, and given that you do the managed services, how you ensure the quality in the hospital, and can you also give us some insight regarding the performance of the Cempaka Putih if you compare to the other new hospitals?
I think, Vanessa, it's precisely because it's a managed services model that we can ensure the quality, which is why I highlighted before, it's not a franchise model whereby we lend our name for somebody else to operate. Keep in mind, in this case, we manage everything, from finances to operations to doctors and so forth. So the only differences in here is that the capital is being deployed by somebody else, not Siloam. But otherwise, it is using our system. We look at it through our own management reporting dashboard. We basically view it no different to any of our existing hospitals. It is just that the source of capital is different. Other than that, as far as management is concerned, it's just another one of our hospital chain. Cempaka Putih, I would say that it's performing in line with target. I mean, certainly there's a certain period that will be expected for ramp up. But Varun, you might have something further to add. But certainly we would say that we are happy with how Cempaka Putih is coming along.
Yeah, absolutely, Darren. Quite aligned. Nothing additional to add.
All right, get it. I think my last question is regarding several news mentioned that CPC might exit from Siloam. I mean, can you share regarding the how big the CPC collaboration
recording stopped
role in your company? I think that's all for me.
Sorry, Vanessa, I could not capture the question. How big is the collaboration with?
How big CPC's role in your management?
CVC, is it?
Yeah, CPC.
Oh, okay. I think this question was touched upon by Daniel last quarter as well. Daniel, do you want to take it again?
Yes, Vanessa. That is a very good question, but perhaps it's a question best directed at CVC instead of as to when and whether CVC will exit. Except to say that we have a very good relationship with CVC. They have always been a very good partner to us. CVC does not get involved in day-to-day management. They have, I think we have gained enough trust in terms of our working relationship with them. They obviously do have a seat at the board. They contribute, they have a member at the investment committee. We've always valued their advice and their insight that they bring. But day-to-day, CVC has no direct operational involvement in terms of what's been conducted. They have been a very collaborative shareholders for us in terms of adding insight and values where needed, and we appreciate them for that. But again, day-to-day operational management will not be affected. I mean, whether CVC does exit or not.
Okay, got it. Thank you so much, Daniel. Thank you.
Recording in
Farhan,
progress.
And thank you, Willie. All the best.
Yep. Thank you, Vanessa, for your questions.
Thank you,
we,
Vanessa.
we have one more time to answer to answer last question from the floor. It's from Angus. Do you have any updates on the prospect of and development of medical tourism in Indonesia and especially in Bali?
All right, so allow me to take this one. It's a simple one. It's a very interesting question, and I've been responding to this question over the last 2-3 weeks to various people in multiple forums. Indonesia is a net exporter of patients currently, and I've said this in the past as well. This trend will change. This is a multi-year trend and will change in favor of Indonesia. So two things. One, Indonesians who travel abroad more and more will tend to stay back home because everybody wants care around home. And second, we will certainly, as we develop more on talent and technology, infrastructure is fantastic already. We will see more and more patients coming to Indonesia just by the arbitrage that Indonesia enjoys. We've already started to see that in Bali. We do some elective cosmetic work where we do see patients coming in from other parts of the world coming in. But have we currently reached a stage where we are looking at developing centers for medical tourism? No, we're not there yet. I think a lot has to be done around that. So that's my response. Has the trend started to set in? Absolutely. We've alluded to some numbers in the past, and Willie, Daniel, correct me if I go wrong. We used to get about 1% of our throughput coming from international patients 4 years back, and that number is hovering between 2 to 3% now. In fact, tending towards 3. So that's a very clear indicator that more and more people who travel abroad or have the options of going abroad prefer to stay back with Siloam in Indonesia. So I think that's my response to you.
Sure. Thank you, Pak Farun. So before we close the call, do you have any closing remarks from Pak Daniel and Pak Farun? Because we've already covered a lot of topics in this today call.
So maybe one quick comment. I think over the last 3-4 years, we've all, and your questions have been around hospitals that are new, not so mature, may have been, kind of eating into the EBITDA contributed by more mature hospitals. So I think that piece now, in our own conversations at the board level, we've started to say, okay, we're done with that. Most of our hospitals are today generating positive EBITDA. And therefore, we are now looking at going to the next level. What is the next level? The next level is how do we, we're a 41 hospital network, and every hospital is different. So we've started to bucket them in archetypes, and you'll hear more from us as we go forward. Broadly, 3 archetypes, but we'll have subcuts as well. So we're looking at premium, we're looking at value seeker, we're looking at BPJS. And what we want to do is we want to provide more on premium. We want to provide what's required from a value seeker standpoint, therefore gain favorability on our OPEXs. And also, Daniel and I were speaking the other day, we also need to build accordingly. And the third category is going to be BPJS. So we will, once we move to these archetypes, we will see that we are offering more at the premium level because the consumer seeks it, is willing to pay for it. We are, and maybe to a degree, look at the brand as well. But I think I'll pause here, Willie, for now. And we will continue to update all our investors on what we're doing in the subsequent quarters.
Sure. Thank you, Pak Daniel, Pak Farun, for your explanation. And thank you for all participants who joined the call. We really appreciate your time. If you have any questions, please reach out to me, and we'll see you on the next webinar. Thank you, and have a good day, everyone.
Thank you, everyone.
Thank you, everyone.
Bye-bye.
Recording stopped.